Exactly 1 year ago, I started a portfolio with just $5,000. The goal? To build it up as quickly as possible, using the strategies I talk about on this channel to the point that it can generate a full-time income. Now, of course, getting to that point will take longer than just 1 year, but throughout this first year, I've made some pretty solid profits, and more importantly, I've learned a lot of things along the way. Things that I plan to apply going forward, and that you may want to apply in your own portfolio. So without further ado, welcome to the road to financial freedom. So as of the end of the trading day on December 3rd, 2021, the portfolio is sitting at a balance of $17,534. And that's based on a total deposited amount of $14,250, as I've been making regular deposits into the portfolio of $100 every single week. So this represents a total gain of $3,284, or a 27.6% money weighted return, which is about a 2.1% return per month. And for reference, that compares to the overall market, which was up 22.1% over that same time period. So this portfolio has slightly outperformed the market, which is great, and an extra 5% per year would make a huge difference over time. But I still think this is only the tip of the iceberg. As I've already alluded to, I've definitely made some mistakes in this portfolio over the last year, so I would expect the performance to be even better going forward. But before we talk about that, let's take a look at how we've gotten to this point. So for those of you that aren't familiar, the main strategy I use in this portfolio is covered call writing. And my goal is to bring in between 2 to 6% per month in premiums. But this journey hasn't always been easy. There have been months where I brought in significantly more than 6%, and there have been months where I brought in less than 2%. But over the last year as a whole, I've brought in a total of $5,837 worth of premium. And specifically over the month of November 2021, I brought in $1,150 worth of premium, which is just over 6% as a percentage of my portfolio. So it was a solid recovery after the past couple of months where I had brought in less than 1% per month. And that was mostly just due to the fact that several of my covered call stocks had fallen in value. So that brings me to the first lesson that I've learned from this portfolio, which is that stock selection is extremely important, often even more important than the actual strategies you use, at least to a certain point. And I did know this to some degree, so in my main portfolio, which I currently use for income, I like to trade solid blue chip stocks like Apple, Microsoft, and Nike, because those types of stocks tend to perform well over time, they provide solid covered call premiums, and their performance is relatively stable and predictable. But unfortunately, due to the smaller size of this portfolio, if I wanted to sell covered calls, I would have to sell them on cheaper stocks. Now, I do have criteria that I typically follow when choosing which blue chip stocks to trade. And so naturally, when I started this portfolio, I applied that same criteria to the cheaper non-blue chip stocks that I would be selling covered calls on. And while it worked out okay at first, things started to go south pretty quickly. So it is actually down in value by $688. So I'm actually down about $242 right now, with a total loss right now of about $730. So overall, of course, I'm not very happy with how this portfolio is performing. So I knew that something had to change. And what I decided to do was sell more poor man's covered calls rather than traditional covered calls. That way I could afford to trade some of the more solid blue chip stocks that I typically like to trade, and I could still use them to generate premium while taking advantage of the rise in those stocks. So since I've switched my strategy over, the portfolio has performed very well, going from being down 7% all the way up to where we are now, being up about 27%. However, since I'm now holding mostly LEAPS options rather than shares, the portfolio is quite a bit more volatile. In fact, just a few days before this portfolio's 1-year anniversary, it was up nearly 42%. It then dropped all the way down to 24% before recovering back to 32% at the time of filming this video, just 2 trading days later. So swings like that are pretty extreme, but as the portfolio grows and I'm able to further diversify it, those swings should become much smaller. So now that we're caught up to speed, let's take a look at the stocks that I'm currently trading. And for those of you that have been watching this series for a while or following my weekly updates on Instagram, you know that I've been selling covered calls on ChargePoint, so I currently own 200 shares of that stock, and I've also been selling poor man's covered calls on both AMD and Nike. Now the one stock that I've added since the last episode is Arcimoto, and honestly this one is quite speculative since the company is in its early stages and doesn't have a ton of revenue yet, but it does yield nice premiums, and as I actually discussed in the very first episode of this series, it's a company that I really like, but it will take some time for it to grow to its full potential. So the reason that I entered this trade rather than another poor man's covered call on a more established stock is just because, as I mentioned before, I'm already holding a lot of LEAPS options, and I just wanted to provide myself with a bit more protection by buying some actual shares. So at the moment, I'm actually pretty happy with all of the stocks that I'm holding. ChargePoint is one that's pulled back since I bought it, and it was actually part of the reason for this portfolio's poor performance initially, but I think the stock is going to do very well going forward. They actually announced earnings yesterday, December 7th, and they showed strong revenue growth along with projections for even stronger growth going forward. So I think that as the EV industry continues to grow, ChargePoint is going to grow right along with it, as it has been up until this point. And one other trade that I opened on ChargePoint last month was a bear call spread. So if you're not familiar with my bear call spread strategy, I'll leave my full tutorial linked below. But basically this strategy allows me to generate premium and profit even if the stock doesn't rise in value. However, in this case, it hasn't actually worked out as well as I had hoped. So in order to set up this spread, I bought a $37 strike call about 3 weeks out, then sold a $29 strike call at the same expiration date. Then at the same time, I set up an automatic buy order to purchase 100 shares of ChargePoint if it rose to $28.50 per share. And at the time, ChargePoint was trading around $26 per share. So I brought in an initial premium of $82 for setting this trade up. And typically it works out where if the stock rises and my automatic buy order gets executed, that stock has some positive momentum, so it will then keep rising and I'll get my shares called away from me. In this case, that would be at the $29 strike price. But what happened here was basically the worst case scenario because ChargePoint hit that price of $28.50. So my automatic buy order got executed, then the stock immediately started dropping again. So it reached a high of just about $28.51 for around a minute or two, and that was the highest the stock had been since July. And now it's back down to around $20 per share. So of course I still brought in that initial premium, but now I own 100 shares of the stock, so it just turned into another covered call on ChargePoint. And I'll be selling calls around the $29 strike price until it recovers. So again, this trade usually works out much better than this, but no trade is completely risk-free, so this is a good example of how it can actually work against you sometimes. Now getting back to my covered call stocks, AMD is in a very strong position as well, which I've discussed quite a bit in previous episodes, so I won't go into too much detail here. But I will note that although it's pulled back a bit, I still really like the stock. I think what we're seeing now is just a bit of end of the year profit taking, seeing as how the stock has performed so well year to date. And the way I see it, this pullback just leaves me with some more upside in the stock. So I can continue selling calls against my leaps option, still bringing in pretty solid premiums, even selling calls about $20 to $25 out of the money. And the same is true with Nike, although it hasn't pulled back nearly as much as AMD. So I can sell calls about $5 to $10 out of the money and bring in very nice premiums. So again, Nike is a company that continues to show great growth year over year, and I think that as we finally make our way out of this pandemic and the supply chain issues that we've been seeing work themselves out, the stock will do even better. Now, the other primary strategy I use in this portfolio is leaps option buying. And essentially my strategy is to buy a leaps option with a delta anywhere between 0.3 and 0.8 on a stock that I'm very bullish on, and then I plan to sell that leaps option within about 1 to 4 weeks for a quick profit. Now, it doesn't always work out that way, as of course I can never predict exactly what's going to happen with a particular stock, but it has been a pretty solid source of income for this portfolio. So over the past year, I've collected a total of $2,369 through these short-term leaps trades. And in a lot of months, I was able to get in and out of at least one trade for a decent profit. But there was one instance that I held an option for an extended period of time, waiting for it to recover, and that was from February to August. You see, for a few consecutive quarters, AMD had been reporting great earnings, and I anticipated that the stock would rise in response to those earnings. But for the longest time, it did nothing. Until finally in August, the stock started to gain some momentum, and in October, after the company's third quarter earnings report, the market really started to recognize it. So a lot of my leaps trades since that point have been on AMD, but I've also achieved some quick profits on stocks like Apple, Nike, and Square. Now currently I am holding an Apple Leaps, which is already up in value by a few $100s. And you might remember from the last episode that I previously had a poor man's covered call set up on Apple. But since I really like the position that the company is in right now, and I don't want to limit my upside, I decided to buy this Leaps option instead. So even though this Leaps is profitable already, I plan to hold it for just a bit longer since I don't have any other trades going on Apple right now, and this option expires so far out in time anyways. And once Apple hits around $180 per share, assuming that happens within the next few months, I'll plan to re-evaluate and see what I want to do here. Now the next portion of my portfolio is my long-term holds, and this makes up about 15% of my portfolio. So these are just the stocks that I invest in and plan to hold for the long term. And so these help me to diversify my portfolio, therefore stabilizing it a bit, while also helping me to grow the portfolio over time as the stocks appreciate in value. So this is another area where I've made a slight adjustment since the beginning of the series. As you can see, I'm holding quite a variety of stocks here, and while they have performed well, I've recently decided to make the switch to buying index funds rather than individual stocks. And this is for two main reasons. Number one, index funds contain a very wide variety of stocks, so they allow me to diversify a lot without putting down a ton of capital. And number 2, it's actually pretty hard to beat the market just by buying and holding individual stocks, so I'll likely achieve at least the same, if not better, performance over time with these index funds than I would buying individual shares. So the index funds that I like to buy are DIA, which is a Dow Jones Industrial Average Index, QQQ, which is a NASDAQ 100 index, VOO, which is an S&P 500 index, and VTI, which is a total stock market index. And if you want to know why I think these long-term holds are so important for protecting your profits, be sure to check out my most recent video right here where I talked about exactly that, along with some other methods that I use to protect my stock market profits. Thanks a lot for watching, and I'll talk to you in that next video.